If you're concerned about when major shifts are going on in the economy, or you just want to be aware of what's going on so you can make educated choices, that's what we're about. To support and around your family and your finances. Things are changing constantly. My goal is to translate financial noise into understandable language so that you know what's going on and you can get into position before it's too late. We know what happened in 2008, but it started right here with the repeal of Glass-Steagall, which separated deposit-taking banks from investment banks. And suddenly, even though that was put in place back after the stock market crash in 1929, apparently it was no longer valid. You really think so? Because after that, a year later, well, they passed Commodity Futures Modernization Act of 2000, and essentially what it did was said all these derivative products that we're creating, do them over the counter. They don't need regulation. They will self-regulate. All right. So all of these big leveraged bets, because that's what a derivative is, just a big leveraged bet. The banks were allowed to proliferate this arena. And there was no oversight. In 2000, the same year, as they did the exemption for the derivatives, and a year after they repealed Glass-Steagall, housing regulations were repealed. Well, let's see, did we have a housing boom, a real estate boom, where people that couldn't afford the houses encouraged to buy the most house that they could and do it with variable interest rates? And who was making money from this? Yeah, the banks, those that were doing the derivatives, and lots of other companies that grew up around this housing market explosion. And I remember it was August 2005 where we got the signal that we were near a top in the real estate market. Well, it kept going up until January of 2006. But no, they cannot keep doing this forever. No, they cannot, because this is insanity and this is all risk. What does the Bank for International Settlements say about gold? It is the only financial asset that runs no counterparty risk. The only one. Okay, in 2003, well, rather than controlling what was happening in the real estate market, they added more support. Here, they added more encouragement to go out and buy all of this real estate that they couldn't afford. And that was a mom and pop area. Was this really setting up for this next phase that we have been enduring with corporate takeover of residential real estate and rental units that happened since 2008? Because this one's like this next one, 2005. And by the way, when they name these things, whatever the name is, it's just the opposite. In reality, the name is just to cover up what they're really doing, the deregulation and the risk that they're adding to the market. So this one is called the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005. And what it did was it put the holders, the owners of those derivative contracts at the front of the line in a bankruptcy. In fact, it gave these creditors, these derivative owners, the ability in many cases to push corporations into bankruptcy, to force them into bankruptcy. And then they're first in line. So, hey, if you were a vendor that was selling to a company and the company didn't pay your bill, you're behind the person that took a bet or the entity that created a bet against that company. Does that sound right to you? Does that sound like it bankruptcy abuse prevention? Or, oh, how about consumer protection? No. That is bend over baby. Then, okay, the crisis hits. What do? They authorize TARP, which is giving billions and billions and billions of money to these failing institutions that made all of this money on all of these bets. And whose money are they giving? That's the piece that people really also don't realize. They're spending your money. Congress is spending taxpayer dollars. The Federal Reserve is spending taxpayer dollars. We taxpayers are the ones that pay for all of this. We pay for it. We are the ones that are taking the biggest risks. I mean, you don't have to look very far to see that. You can look back to last year, 2020. You can look back to 2008. Who really suffered the most? It was not the banks or the financial institutions or the corporations. And then, of course, we had Dodd-Frank. So after 2008, Congress rode in on their white horses and they put in place this Dodd-Frank that was something like a gazillion pages of legislation that got passed without anybody reading it. And oh, by the way, this was supposed to protect the consumers. And a lot of the things that protected the consumers were never even implemented until they started to just, basically dissect and take it down, the Dodd-Frank Act. Rollback in regulations. The biggest rollback of bank rules since the financial crisis. Do you think maybe that could have set us up for more risk? And why you see these markets at the highs that they are? Because of all of this deregulation. And what that does is it adds risk to the little guy. And what? They'll give the little guy a little bone so that they can then say, hey, we're really protecting you. But you are not the one that really benefits. I mean, we can look at, say, the retirement crisis that we're in. So many pensions, so many retirement funds are based on stocks and bonds and ETFs and even derivatives these days and all sorts of garbage. So, hey, they've got to keep it floating for that reason. It's to keep you blind. It's so that you don't really understand what's happening. What's been tested? Gold and silver. That's been tested over thousands of years. Nothing else.